Hey everybody, so the Fed has not lowered interest rates yet in 2024 while signaling that they may decrease rates in the second half of the year. So in this video, I'm going to break down how interest rates affect your life, how big of an impact interest rates have on mortgages, and plans that you can do for the future. All right, as a little bit of a backdrop, the Fed has jacked up interest rates to try and decrease inflation. Inflation is the rising cost to buy an item. And so typically the Federal Reserve likes to keep inflation at around 2%, meaning that every single year the cost of an item is going to go up 2%. There are many things that drive inflation. Some of it is just simple economics. So when supply is lower than demand, then prices increase because more people want that thing, but there are less of those items available. And so those who sell that item obviously can jack up their costs, which is good for them, right? That's business and that's totally fine. Typically what ends up happening is other companies see that there is a chance to make money, so they start creating that item and that drives supply a little bit higher. And then you kind of get an equilibrium where demand versus supply will kind of find its middle ground and you'll have a stabilization in price. Obviously, when supply outdrives demand, then prices will decrease because competition and the businesses will want to try and get you to buy their product by lowering their price. One place you can see this, and I'm sure it changes in every single market, but in the market that I live in, housing is actually in low supply and higher demand. And so the house prices have kind of increase significantly over time. Or you've got the classic example where a parent is trying to find the popular toy in Christmas, and because of it, they're willing to spend a ton of money on it because supply is not there. Now, another huge driver of inflation, and probably the most significant driver of inflation that we've seen in the last 3 or 4 years, is when the Federal Reserve will actually print more money to get more money into the economy. They usually package it as like a stimulus package. So a lot of that happened during COVID, where they were saying, hey, we're just going to send out money to everybody because, they may have lost their job or they're sitting at home because they can't work because of social distancing or whatever. So they created all this stimulus, put a whole bunch of new money into our economy, and because of that, it dilutes the value of the current money that is in there. Just think of it this way: if all things are equal and there are 1,000 gold coins out in the world to be able to spend on whatever, you use it as a trade, you're buying apples, you're buying flour, whatever, and then all of a sudden someone comes and says, okay, I'm actually going to put another 500 gold coins into the market. Now, all of the other things have stayed the same. There's still the same amount of apples. There's still the same amount of flour. Now, all that has done is made the first 1,000 gold coins worth less money because now there are more gold coins out in the world. So what ends up happening is the market adjusts and actually increases price because of how much more new money is in the market. And that's what happened with us. We had COVID. We put a whole bunch of money into it, a bunch of stimulus packages. It got all sent out to people. They had more money. And then what ends up happening is businesses, seeing that there's more money in there, just gradually increase prices, right? Which kind of sucks for a consumer because that means you're spending more money on items that you used to could buy for less. Now, to combat high inflation, the Federal Reserve has increased interest rates to help drive down prices. What this does is by increasing the interest rate, it disincentivizes people from borrowing money to go and buy things. And so when they don't go out and buy things, then the demand for items decreases and that results in a price drop. So they make borrowing more expensive, then people don't want to go buy as many items, and then demand decreases. And then because demand decreases, businesses drop prices and it reduces or slows down inflation. That's the theory behind it. All right, if you are finding value in this video thus far, please hit that subscribe button. It helps me keep this financial content going. So having a higher interest rate set by the Federal Reserve means that it is more expensive to borrow money. This can be mostly seen in the housing market. Obviously, with higher interest rates on mortgages, then buying a home gets more and more expensive. For example, in 2020, the average interest rate was 2.7%, where right now on a 30-year mortgage in 2024, your interest rate is going to be 7%. This can end up making a huge impact on your monthly payment. So in 2020, if you financed a $300,000 house, say you financed the whole thing, and you were an interest rate of 2.7%, then your mortgage would be like $1,200. Now, fast forward to today, if you were going to finance that same $300,000 at 7%, then your mortgage is almost $2,000, which results in almost an $800 increase for the exact same house on your mortgage. That's a monthly payment. So that's almost 10 grand a year more just in a mortgage. Now, in theory, what's going to happen is you have high interest rates, which is going to decrease demand. And because of that, eventually people selling their houses will decrease prices. But I don't think we've seen that quite yet. You'll have to let me know in your market if you've seen any downfall in the real estate market, if you've seen price drops on houses. But if you are that person who is looking for a house now and you're wondering how much house should I buy, you should use the 28% rule. So take your gross income for a year. If you can spend 28% of that on housing, then that is what you should do. 28 or lower. Don't go above that because it puts too much of a financial strain on you and your family. So for example, if you make $60,000 a year, that's $5,000 a month. 28% of $5,000 is around $1,400 a month. That is what you should aim for, $1,400 or less on your housing each month. You may be saying to yourself, well, I can actually just buy a more expensive house now because the Federal Reserve is signaling rate cuts at the end of 2024 and throughout 2025. And then when rates are lower, I can refinance. And I 100% agree that is an option. But I think if you're going to go above that 28% rule, it is a dangerous game to play because you're just banking on the fact that the Federal Reserve will indeed lower interest rates, where they've signaled interest rate cuts in 2024, but they keep pushing them off because inflation has stayed high. So I think that's a dangerous game. I still think you should follow that 28% rule and keep your housing costs below 28% of your gross income. Now, what about a car? What impact has it made on buying a car? If you followed my advice, it should make no impact at all because higher interest rates shouldn't matter when you're buying a car because you should not finance buying a car. If you can't buy it with cash, save up and go buy a used car. Find something cheaper that works. Don't worry about going and financing a new car. It's just not worth it. All right, so how much will a signaled rate cut at the end of 2024 actually help? So typically when they drop rates, it's usually by 250 basis points. That equates to 0.25%. So it'll drop, if we have a similar drop in the mortgage rates, your mortgage might drop from 7% down to 6.75%, which with the example that I used earlier for a $300,000 house, it'll drop your monthly mortgage by about $50 to drop that 0.25% when the Fed cuts rates. So that's not a giant savings. Now the real savings will come if they actually follow their plan for 2025, which they're signaling for 5 rate cuts, which would equate to 1.25% drop in interest rates. And that's where you'll end up actually saving a couple $100 a month compared to, financing at 7%. If you can finance down at the 5.5%, you'll save a couple $100 a month on a $300,000 mortgage. So that's when the real savings happen. Now, those are the downfalls of high interest rates. One of the positive aspects of the Fed having a higher interest rates is then banks also will have a little bit higher of an interest rates on savings accounts. So there are many high yield savings accounts right now that you can get above 4 and possibly even 5% on your money in interest income. So with high interest rates right now, I think the thing that you can do is, one, be smart with your money. Don't go out and borrow expensive money if you don't have to. Pay cash for as much as possible. Really, you should only be financing a house. If there's anything else out there that you're doing, don't finance it with a credit card. You're gonna get screwed over. You're gonna have insanely high interest rates on it. And then don't finance a car. Pay cash, save up, be smart with your money. Number 2 is go open a high yield savings account. If you can make 4 or 5% on the money that you have in your savings, then go and do that instead of just leaving it in a checking account and making no money on it. And my last tip, it's a self one. Subscribe so you can keep getting financial tips. Thanks, and we'll talk to you later.